Well, we'll get started. It is the end, not technically the end of first quarter. We finished first quarter for 2024. I know it was full of lots of headlines and the market's doing some crazy things. However, we made it. And Pete Eisenrich with Clark Capital is gracious enough to take some time out of his busy schedule today to come and recap what happened in Q1, talk about kind of what expectations, will help us manage expectations really for 2024 and give us an overview and kind of where things are right now. Pete, you've always been gracious. We appreciate you taking more time out of your schedule to help us cut through just the static of what the news media tells us. I know there's plenty of headlines. I was having a conversation with my 14-year-old daughter this morning about how the news media gives us lots of static. She, at 14, goes, yeah, the news media lies about a lot of stuff. So, anyways, without further ado, we will go ahead and get started. Of course, the joke about the news media was a joke, in case anybody, well, if you feel that way, great. Otherwise, it's all right. But Pete, give us the rundown on, I guess, and real quick for anybody who doesn't know Pete, when Pete speaks, the markets move. Just kidding, of course. Just kidding, of course. But sincerely, though, Pete, I know I've told you this before, but I mean, y'all's insights into the markets, it's not that there's a crystal ball by any means, but I mean, you've been a CFA for a long time. You've been doing this for a long time. You know the nitty gritty of what's going on with the economy. There's always uncertainty that's going to surround anything about the future. But you've always given a great insight into kind of like what's going on and just kind of gotten to the bottom line, and appreciate the insights today. So with that, I'm going to let you take it over. I may ask a few questions, recap here and there, but I know we've done this before and we kind of have a format we follow. So take it away.
Thank you, Mark. I appreciate being able to join you and your clients again. And yeah, I'm going to go through and really kind of, as we were going through the first quarter, what were we seeing and kind of what were we expecting, and then what happened. I mean, what's interesting is when we kind of step back, things are pretty good, right? Maybe not great, but things are pretty good when we think of the economy, what's going on with the Fed. The market, again, had a very good first quarter, really good end to last year, and then that continued in the first quarter. So, things are kind of, trending pretty nicely right now when we look at the bigger picture. I've got my slides again where there are some areas to give a few updates. I will do that, but let me get through that. I was telling Mark, it usually takes me 25 minutes or so to get through these slides. And then, certainly happy to answer any questions that might come in. And Mark, obviously, if there's an area you want to stop me and recap, feel free to do that. So I'm going to share my screen here, and hopefully that looks good on your side, Mark, and everybody. A couple of kind of reminder slides, which we thought were important to include as we were kind of starting the new year, was, this has been a really good run in the market, right? Been a very good period from those October lows from last year. We just like to remind people, remember, volatility is historically a part of being an equity market participant, if you will. So just a reminder that, we get 5% corrections are occurring about maybe a little bit more than 3 times a year. We have not had these in the last few months, right? This has been a very steady run higher. And, interestingly, we average about a 10% correction every year. We did go through one last year when we kind of hit a high point in July. August, September, October, we're down. As we're kind of going through those periods, what we're doing at Clark is we're saying, has something fundamentally changed, or is this the market being the market? And really, when we were going through that period late last summer and into the fall, we kind of thought it was the market being the market, and we've really had a good recovery from that. But I feel a little bit like the pilot where, hey, we're going to get you to your destination, but we could have a little turbulence here in the next 15 or 20 minutes during our flight. That wouldn't be surprising from our perspective, especially based on the run that we've had that really started in the later part of 2023. Just kind of an interesting slide when we looked at those 2 years, right? So we know how challenging 2022 was. We know really had a good rebound in 2023. It was a kind of a later rally for a lot of areas of the market in late 2023, but we had a good bounce nonetheless. And you kind of look at those 2 years combined and, kind of modestly, modest gains on the equity side, still seeing international struggle. And for the most part, outside of those high yield bonds, still seeing a challenging couple of year period when we look at what's happened in bond markets. Let's go to those 5 gauges. As you know, when I've talked before, we were covering those 5 gauges. Then I've got a couple final slides on some topics that might be top of mind. The election, what's going on with our debt. So I'll touch on those as well. But, the economy gauge, the consumer-driven economy has really defied skeptics. We still expect the economy to slow down, but we think that's what it'll do, is slow down from some pretty good growth that we had in the second half of last year and kind of get toward what we would call more trend-like economic growth. And I'll explain that in just a second. Yes, we've had a couple of choppy inflation readings over the first part of this year, but we think overall it's still trending lower. We think it is still on track with these economic data points. We don't usually expect them to go in a straight line, right? We expect there to be a little bit of volatility along the way. And we had some of that earlier in the year, but we do think the trend is still showing improvement for inflation. And then earnings, really an important area for us. Earnings really look like we hit a new all-time high in operating earnings in calendar year 2023, and earnings are expected to grow in 2024 as well. Again, just kind of a picture, the most anticipated recession that really didn't happen last year when we look at all the people that were talking about it coming into the year. And when we look at it, I know we're kind of looking at the far right, we actually had about 4.9% GDP growth in the third quarter last year. Remember, GDP is just the biggest measure of our economy. What in total is our economy doing? So really strong growth in the third quarter, that 4.9%, that's an annualized number. And then we don't have it here, but about 3.4% is what the fourth quarter looks like the growth came in, about that 3.4% level. I can tell you there's an Atlanta Fed GDP now where the Atlanta Fed tries to track what they think current GDP and the economy is doing. Right now, their estimate for the first quarter is about 2.5% GDP growth. Obviously, we won't get the first reading on first quarter growth until much later this month. That's when we'll get the first estimate. So we in the US, we actually update GDP 3 times. So over the next 3 months, we will get kind of an initial estimate, then a secondary estimate, then that third reading of GDP will come really late in the quarter. But again, it's showing that kind of slowdown that we expect, but still growth nonetheless. Now, we can't eliminate the possibility of a recession, but in our opinion, we think that has diminished. If I was talking to you last year, which I know I talked to Mark and his clients pretty frequently, we were kind of more, boy, it might be a 50-50 on whether we have a kind of a modest recession or whether we have the soft landing. We would say the odds are now favoring the soft landing, but again, we'll still kind of keep our eye on if this weakness does go into a technical recession. Again, not our base case as we stand here today, kind of looking out in 2024. And boy, the job market has continued to be strong, right? We know the U.S. economy is a consumer-led economy. You and I outspending money, we call it household consumption in the GDP report. Household spending is about 70% of the economy. So if we have a strong job market and people that are able to get jobs, wages that are, reasonable where they can spend that money, that tends to be a good signal of what's going on with the core of the U.S. economy. And that has continued to really be solid over the last couple of years. We know we went through a really challenging market in 2022. We know it continued to be kind of a challenge during the first part of 2023. But the job market has really remained solid when we look at it. The unemployment rate, the last reading we had was 3.8%. So again, still showing really good unemployment numbers. That's up a little bit from some of the lows we had about a year ago in the earlier part of 2023, but still, sub 4% when we're looking at that unemployment level. Here's just some inflation reasons. Again, we think that trend is still pretty clear, showing improvement in inflation. Not a surprise to see a number here and there. It might change, might go up a little bit, but we do think that trend and improvement is still happening on the inflation front.
Pete, really quick on the inflation point. Something that I always try to remind everybody about is that inflation measures the rate at which prices are increasing. And just because we've seen inflation slow down, which is a great thing, it doesn't mean prices are going to go down. That's disinflation, I guess?
That's right. Yeah. Yep.
Where, if prices were to go down, deflation, I mean, the Fed does not want that, because then consumer spending grinds to a halt. Because if we all know things will cost 5% less next year, we're not buying it today. And so the Fed's goal is not to get prices back down per se, but instead slow the rate at which they're increasing to a target of 2%. Is that accurate?
That is right, Mark. And you said it exactly right, where I think people have that misconception. Yeah, we're still dealing with, we know inflation, what those worst periods we were up 8 or 9% on an annual basis. So it is the rate of change. We know we're still at an elevated price level right now, but that pace of change is now slowing. And that's really what the Fed can target. So we know it's still, a little bit expensive to buy eggs or milk when we kind of look at some of those areas, but that pace of inflation has really improved. And that's where the Fed targets about that 2%. Again, some inflation from those central bankers' perspective is healthy in an economy. That's why the target isn't zero, to your point, Mark. They do target about that 2%. So we're still above that, but we're trending toward that. And, I think the Fed, with where the economy is still growing. It's still showing some pretty good numbers. They're probably not in a hurry to cut rates because they really do want to see those inflation numbers clearly trend toward that 2%. But I think we are still showing some improvement on that inflation front. That's a good point, Mark. This next slide, leading economic indicators. So this is an area that had really slowed for the last year and a half, 2 years. Actually, our latest reading on the LEI is actually ticked a little bit higher. So, again, 1 month is not a trend in our world, but again, we're starting to see even this reading has showed a little bit of very recent improvement from those declines. Leading economic indicators, you can see we tend to see those start to roll over prior to, remember, that vertical kind of beige column is a recession. So you can kind of see that historical trend of leading economic indicators tend to roll over. That has historically at times led to a recession. We've had these slowing down for the last, like I said, year and a half, 2-year time frame, and haven't had the recession. So again, people are going to evaluate, okay, are these leading indicators still kind of dialed into what is causing growth in our economy? Are they a little bit too much goods focused? Again, way beyond the scope of this discussion, but this has been something that has kind of caused us to say, okay, we need to be aware of some potential slower economic growth, but we really haven't seen it to a large degree. We've really seen an economy that has continued to show growth. We do believe ultimately what drives stock prices is earnings. And we've gone through some periods where earnings decline and we did see the stock market decline, right? Coming out of the dot-com bubble in the early 2000s. You can see that orange line rolls over. Prices came down. We all know, if any of us were invested in the 2000s, we know there's a pretty good stock market correction from 2000 for a period of time. Same happened during the credit crisis. Now, pandemic, we had it in a very short order. What was interesting is, yes, earnings went down in calendar year 2022 from calendar year 2021, but they went down about 5 or 6%. The S&P in 2022 went down a little bit over 18%. So from our perspective, as we were coming into last year, we thought there was some opportunity. We thought maybe stocks were pricing in too much of a slowdown based on what we were really seeing from earnings and from the economy. And again, I think that kind of set up that environment where we got a pretty good rebound in earnings and then in stock prices last year in 2023. Here is just kind of that estimate on earnings. And these are about, I think we have had all 500 companies of the S&P 500 report, and usually it's not right at 500 when we look at that. But I remember I was talking to one of the analysts, and I think there was one outstanding company. I can't remember if that was earlier this week or last week, but we're coming in at around that $214 area for operating earnings for calendar year 2023 last year. As you can see, it's not really a good visual here. It looks like the columns are a little bit skewed, but 2021, we had 208. So one of the questions I often get asked is, guys, are you nervous because stocks are at an all-time high? Well, earnings are at an all-time high, right? So there is a fundamental reason why stock prices have been able to move higher, because in calendar year 2023, we had the highest operating earnings that we've had. Now, what's supposed to happen this year? Operating earnings are supposed to grow into kind of that low $240 range, about 13%. I think it's coming a little bit, so 12 or 13%. And even if it drops into single digits and we still get single digit earnings growth, that would still be record growth off of what we're going to see in 2023, what we saw in 2023. So I shouldn't say record growth, but record earnings from that 2023 number. So the fundamental backdrop with earnings expected to grow this calendar year, that is kind of creating this positive backdrop for the market where, okay, earnings are expected to grow. We think that PE ratio, price to earnings, if earnings are growing, that does give an opportunity for stock prices to grow as well.
So, Pete, really quick before we move on to monetary policy. So quick recap. So the economy seems to be in pretty stable footing. Unemployment rates still low. Inflation's trending towards the 2% target the Fed has, which doesn't imply prices will go down. Earnings are growing, which is a good sign, because ultimately when you buy a stock, you're buying that company's earnings. I know oftentimes that kind of principle gets lost, especially amongst market pundits.
Yep.
But earnings still matter, and those are forecasted to grow over the calendar year 2024 from about 213, and that actually I think was a revision, or 214. That's actually, I think, Pete, higher than most folks thought that we would end up last year, at around the 205 mark. Is that accurate? So it looks like better than expected originally.
On, Mark. So really depending on when you're looking at, we have been for the last, I know, several months, we've kind of been expecting, or the estimate has been for those earnings to be above what 2021 was. So again, they can fluctuate at times, but yeah, they came in right around that 214 level is kind of what I remember when kind of looking at some of the latest readings there.
So if they're forecast to grow again in 24 by, again, an estimated 13.5%. We'll see what it ends up being. Nobody has a crystal ball to know what that number is actually going to be. I think what you alluded to in your point there. Then that PE multiple, right? So how many dollars is Wall Street willing to pay for a single dollar of earnings from corporate America? Is the simple math then the earnings times that multiplier equals the fair value for the year-end target? Kind of, sort of.
That's the way you call fair value, Mark, right? I mean, that's, but what that tells us is you can have, if earnings are growing and you don't change the valuation. So let's say it's a 18 PE multiple, and if the E is growing, then that means that, again, without changing a valuation, not being more expensive or less expensive, that the prices can appreciate as well. Now, it's not that easy, right? We know these things change around, and to your point, sometimes the market isn't trading purely based on fundamentals. It's our opinion that we think over the long run, that is the primary driver, right? What companies earn is really what that business is worth. And I think entrepreneurs, if you have entrepreneurs that are your clients too, Mark, they get it, right? They operate a business. If they're earning more, they probably feel like their business is worth more money, right? In the market, we change every day what we think valuations are, but we're generally looking at, are the earnings expected to grow? And then to your point, what are we willing to pay from a valuation perspective to get exposure to that particular business? So that is kind of our longer term perspective, how we really try to eliminate a lot of the noise and, be focused on what do companies earn? What are we as investors willing to pay to get exposure to that company's earnings? That's right, Mark. So the next gauge, monetary policy. unmistakably what the Fed has been doing in the last couple of years has been a key driver of the market, right? We went through a very aggressive rate hike cycle, but believe it or not, the last rate hike was in July of last year. And we're not a year now, but we're 9 months, 10 months away from getting that, actually almost a 1-year anniversary from that last rate hike. They've kind of been in this pause mode for the last several months. But the question is now, when and how many cuts are they going to have? And that number has really changed as we've gone through the first 3 months of the year. Quantitative tightening, again, it's kind of this behind the scenes. The Fed is shrinking their balance sheet. They've talked about maybe making some adjustments there, but we'll kind of see what happens there. But it's kind of something not a lot of people are talking about, but there is this quantitative tightening going on in the background. And again, we know 2022, as the Fed was really engaged in this very aggressive tightening cycle, it was a headwind for stocks. And I think the big news and the big point is we seem to have turned that corner, right? Not a lot of people are expecting any more rate hikes. It really is, how many rate cuts are we going to have? We think there will be rate cuts this year. That's our opinion at Clark. So again, that really changes the dynamic of the Fed going from restrictive monetary policy, right, raising rates, to really more accommodative monetary policy by starting to cut rates, making that cost of capital a little bit less expensive. Kind of an interesting slide here. So kind of linking the idea. So remember, the Fed operates under what we call a dual mandate. So they're operating monetary policy with the goal of, one, price stability, right? That's an inflation control, kind of what Mark had mentioned about inflation. The second one is full employment. So, okay, we're at 3.8% unemployment. Job market really seems pretty solid. Fed probably feels really good about that side of their mandate. Now they're seeing inflation improve. So that blue line, that's the personal consumption expenditure index. It excludes food and energy. That is the Fed's preferred measure of inflation. And again, kind of unmistakably, through the end of last year, we can see that has been improving pretty dramatically. The red line, that's the Fed rate hike. So the Fed's goal was to bring down inflation. I think we can kind of say, boy, they've really, to a large degree, accomplished that. The next question is, how long do they keep those rates elevated? When do they start to cut those in order to kind of get the Fed funds rate into more of that longer term level that they want it to be? Having a 5.25% Fed funds rate, probably not the long-term area where the Fed wants the Fed funds rate to be at. And you kind of look at their dot plots to kind of estimate where they want it to be, but likely that will be something they do start to lower just to get closer to more normalized Fed funds level. And again, kind of you look at this, like, gosh, hope they don't wait too long, right? Where we don't want inflation to get into any sort of that deflationary concern, or where they send the economy into a weaker period, a potential recession, by keeping monetary policy too restrictive for too long. So it feels like the Fed is set up to really engineer this soft landing, but we'll wait and see kind of how many Fed rate cuts do they engage in this year. Really interesting slide here. This was at the end of the year. So when we started 2024, you can see the market was pricing in, gosh, it was 6 or 7 rate cuts. And that's those gold bars you can see there. When you looked at what the Fed, kind of what they were putting out with their economic projections, their dot plots, now they don't tell us how many rate cuts they're going to engage in. You have to kind of back into it based on where they think the Fed funds rate will be at the end of the year. So when you kind of looked at that, the Fed was at about 3 rate cuts. So we started the year with the market at 6 or 7 rate cuts and the Fed at 3. Pretty big divide there, right? And again, I would say this is one area that caused us a little bit of concern, where, boy, pretty big difference with what the market is expecting with what on rate cuts with what the Fed is kind of saying where they estimate it'll be. Now, we've gotten updates from the Fed. Where is the Fed at? They're at about 3 still. We got their updates in March. Where is the market? The market has now kind of come back down. The market is about 3 rate cuts through the balance of this year. So if we were to update this slide now, we would only be showing the estimate of about 3 rate cuts based on what the market is pricing in over the rest of this calendar year. So the market and the Fed have really come closer together, right? They really are more in line. And what happened? Did we have this big weakness develop in the market? No, we didn't. So the market was really able to absorb this idea of fewer rate cuts than the market was expecting at the beginning of the year. So it tells me, again, there were some other fundamental reasons why we were seeing the market kind of continue to progress in 2024. It wasn't only based on the idea of a really aggressive Fed rate cutting period. They've kind of come back in line with each other. Market has still been able to show some progress. So again, that seems a little bit more in order now with the expectations for, again, like I said, about 3 rate cuts through the balance of this year, and then maybe one more is being priced in the early part of 2025. And we look at what's historically happened when the Fed is done raising rates, and you can see kind of 3 and 6 months we're past those two, right? So after since it was July was the last rate hike, you can see the S&P 500. So if we're looking at that blue column, the third one over, the blue set of numbers, the S&P historically on average has done better than aggregate bond. That'd be bonds. Bonds have done better than that short-term T-bill money after, about 12 months after a rate hike. And we all know we've had a really good period for the market here. We know there's a little weakness when we were going through August and September and October, but have really had that bounce back with a better period for stocks. And historically, that's what we tend to see. Stocks doing better than bonds, bonds doing better than that short-term T-bill type of exposure. Third gauge valuation. So something, again, we've kind of covered a lot of this, so I'll go maybe a little bit quicker through this, but something we care a lot about. We would say that forward PE. So again, what we're paying from a valuation perspective, we think it's kind of average, not a cheap market, not an expensive market, kind of in line with longer term averages. And we know it's those big tech names, the Magnificent Seven, they're kind of masking better valuations. And I'll show you a slide on what I mean there. And then earnings, we've talked about that. Earnings are hitting all-time highs. They hit all-time highs in 2023. And to kind of Mark's point, we don't know what that growth will be. It's kind of 12, 13% expected earnings growth this year. That'll continue to get revised. But that's where even I say, guys, even if we slipped into mid-upper single-digit earnings growth in calendar year 2024, remember that's coming off of record earnings in 2023. So it'd still be record earnings when we look at what we're going to earn in 2024. Really important when we're looking at valuations for the market. And so here's a slide, so the blue is the forward PE ratio of the S&P 500. Again, this is at the end of the year, and we know these have creeped a little bit higher, and I can kind of give a general update on what we're seeing. So again, you might say, guys, Pete, that is above kind of that green line, right? The longer term historical average. Well, let's look at the Magnificent Seven, and then let's take those out as well. And you can see, again, when we were looking at this, it was kind of back in October, Magnificent Seven, about a 27 times earnings. If you took those out, and so we look at the S&P 493, if you will, at about a 16 times. Now, those have gone a little bit higher. The Magnificent Seven is probably about a 30 times valuation right now. The overall S&P is probably around 20 times right now. But the 493, so we still do that exercise, is about 18 times when we're looking at valuation. So still kind of in that longer term average where we tend to see it. Yeah, it's creeping a little bit higher, but we would still say not necessarily expensive, not necessarily cheap. And we know within the market, there's quite a bit of difference, right? Here we're looking at different areas of the market, different capitalizations, different value versus growth, kind of different styles. So on the left, the S&P 500, the Russell 1000 growth is the next one. You can see obviously growth stocks, which a lot of those Magnificent Seven live in there, right? Large growth companies, higher valuations than the overall S&P 500. But then we start looking at larger value companies, lower multiple than the overall market. The Russell 2000, that's small cap companies, lower valuation. Mid caps, again, a little bit above the small cap, but lower than those large cap companies. Then the international, that's the ACWI, ex-US, and then emerging markets, a little bit better valuations there compared to the US. So again, a lot of nuance in valuations. We kind of say ultimately, okay, it's kind of, in that neutral area, not expensive, not cheap, but we know kind of beneath the surface, there are some areas with better valuations than kind of the headline top market cap, those big tech companies out there. So, that's kind of how we're looking at the market right now. Fourth gauge investor sentiment. So this is one that has given us a little bit of concern, right? What happens when we end with a really strong market rally? You get a lot of optimism building in, right? A lot of bullishness building in. this is a contrarian indicator for us. When we start to see too much optimism, so optimism replacing fear, that can give us a little bit, okay, we need to be a little bit aware that maybe things are getting a little bit ahead of themselves as we look at the market. Very sensitive gauge. It can and does change quickly. And we're not really at mania levels. And a lot of times this gauge is really better at the extremes. But we have seen that investor sentiment, that bullishness continue to pick up. So, that's something we're keeping an eye on. And again, I would say this tells us a little bit on the shorter term what we might see in the market. But remember, what we're really concerned over the market cycle is what's the economy doing? What is the Fed doing? Are they raising rates? Are they cutting rates? Are they a headwind? Are they a tailwind? What are valuations look like? So those other gauges we just went through, that kind of develops our longer term perspective of the market. This tells us, okay, in the short run, we might need to be a little bit aware that, hey, a little bit too much bullishness might be building in this market, could be a point of caution for us. And that's really what this slide shows, is the green. You can kind of see it, that 46.3. And again, this was the end of last year. I know this has kind of been bouncing around in those 40 levels as well. Little bit above what historically we see as that bullishness reading for people. Usually that bullishness reading is on average about 37.5 when we think of the average bullishness. So we're above that. Again, like I said, not in mania levels, but tells us, okay, if we got a little, we would say consolidation or a little bit of chop in here, over the next few months, that wouldn't be that surprising as we look at kind of where the market sits right now, especially after the strong run we've had since that later part of October. By the way, a lot of money is in money market funds right now, too. So you kind of think of what could also help continue to support the market. Boy, if some of this money is kind of earmarked by people to go back into the market, again, that could be a little bit of fuel that kind of helps as well. And we know, again, a lot of dynamics change with rates going up and people going into money market funds from banks where they weren't getting interest. So we know there's a lot of moving parts here. And, we understand that probably not all of this money is meant to be invested. But if even a portion of it is, again, there is some money on the sidelines that could go back into the market. Again, that could help support markets as we move forward as well. And we've really been in a period where we would say momentum has really trumped sentiment, right? Sentiment has told us, hey, a little bit too bullish, might need to be out a little bit of caution here, but the momentum has really overwhelmed what we've seen in those sentiment readings over the last few months. So that's kind of a dynamic we're looking at as well. The final one, interest rates. So really, we generally are kind of tracking what we're doing with monetary policy, with interest rates. We think as the Fed starts to cut rates, we'll see those shorter term rates, meaning kind of, the 2 month, 3 month, 6 month, 9 month, year, 2 year. We think those rates will start to come down a little more. I've got a really good slide I'll show you in just a second on what I mean there. Long rates really did drop late last year. I would say one of the probably more important stories beyond the stock market rally at the end of last year was the drop we had in rates. And again, I'll show you on my next slide what I mean there. We would say rates coming down are not a tailwind yet, but they're probably not the headwind they were either. So we put this in that neutral position, and we are still doing with an inverted yield curve. And I'll show you a slide on that. But late last year, and you can see this is October 19th is where that red line, we're taking the picture there. We actually hit a 5% yield on the 10-year treasury. I think it was an intraday level, but we touched 5% for the 10-year treasury yield. And for those of you that have heard me talk before, we look at that 10-year treasury yield as kind of a bogey interest rate. Like what is generally happening with interest rates? We look at what's going on with the 10-year. Is it going up or down? So we hit 5% on that 10-year in late October of last year. The last time we'd had a 5% 10-year treasury yield was back in 2007. Yeah, prior to the credit crisis. So we were literally at 15, 16-year highs in interest rates as we were kind of getting late into last year. And then what happened? Boy, big rally in treasuries, right? Big rally in bonds really pushed yields down. You can see yields dropped to about 4% by the early part of January. I can tell you they ended the year at 3.88%. So we literally went from 5% in late October to closing the year at 3.88%. That's a pretty big drop when we think of a drop in interest rates over kind of a 10-week period. Now, look at the very front end there, those 1 month, 2 month, 3 month, not a lot of change there. Yeah, they came down a little bit, but remember that part of the yield curve is much more sensitive to what the Fed is doing, right? The Fed actually controls an overnight rate that banks deal with each other on, not something you and I really deal with, but they have a lot more control on that front end of the yield curve, those shorter term yields, and the market really controls further out when we're looking at those 7 and 10 and 15 and 20, 30-year type of yield levels. So again, our expectation is, and what has happened this year, we've had those longer rates move back up. It was such a dramatic drop last year. Not a surprise to see those kind of bounce back up, especially under the belief now that the Fed isn't going to cut as many times as the market thought at the beginning of the year. So those have kind of trickled back higher. We know we're at what, 4.3, somewhere at 4.2, 4.3 on that 10-year now. So again, that has moved up a little bit, but we don't think it'll get back to where we were in late October. And when the Fed does start to eventually cut rates, we think those short-term rates will come down probably even a little bit more dramatically than we see longer rates. So kind of what we're expecting there with rates. This is that yield curve. Remember, we don't think we can stay inverted forever, right? We think this has to get more normalized, a positively sloped yield curve. We're getting it to a degree. We're getting some improvement there, but it's really because longer rates have gone up. Probably ideally, we'd rather see short-term rates coming down and then getting below those longer-term rates, which again would be that positively sloped yield curve, which is what we would expect. We know the inverted yield curve has historically been kind of a warning sign that we might have a weaker economic environment, so something we've taken very seriously, but it hasn't really materialized, right? We have not had that lead to a recession at this point. Tells us, okay, maybe slower growth. But at this point, as I mentioned earlier, we're in the camp that we think we will have slower growth, but a soft landing and not have a recession. We think that's what the odds favor at this point. Mark, I've got just a couple final slides here. So I'll bring you back in, Mark, and we'll answer any questions. But the election and government debt, right? Questions that are often on our clients' minds. So how do we kind of think about that? How will the elections impact the market? Really interesting when we look at this. So this is that 4-year presidential cycle. So what this chart is doing, it's literally taking data back to 1900 and saying, what does that election year look like? What is the first year of a presidential cycle, second year, and so on, third year, right? And it kind of says, okay, well, we're put all those together. What is that typical action that we see? Now, this is that classic historical data point, doesn't need to repeat itself, but we like to look at it as does it give us a sense of what that kind of rhythm of the year might look like? What do we see in an election year, calendar year 2024, that highlighted one on the left? Boy, you actually tend to see a little bit of a challenging period in the first part of that election year. What's typically happening in the first part of an election year? Primaries. Could be primaries on both sides if it's kind of a second term president. And so we know there's going to be new candidates on both sides. There's a lot of uncertainty, usually historically during that first part of an election year. We know that is, I think, a fair comment about the market is the market doesn't really like uncertainty, right? I think the market does a pretty good job of adjusting to whatever rules of the road are in place. But uncertainty is where, you tend to see the market have a little bit more volatility. You can see it tends to give way to a better period later in an election year, and as we move into that first year of a presidential cycle. So let's kind of hope this repeats, right? But this has been a little different year. We actually had a really good first quarter. We are pretty sure of who the two candidates are, right? So again, a little bit unique in what's happening this year. As we came into the year, this was another reason why we thought we might get a little bit of chop in the first part of this year, had a really good run in the market. We were seeing sentiment that was probably a little bit too optimistic, a little too bullish. We thought this kind of coincided with that as well, that we might get a little bit of chop. And that's where we still believe we still might enter this period where we get a little bit of chop here for a few months. But again, historically, that is then given way to a better later part of that election year. So it'll be kind of interesting to see how that comes together. And really the slide that I think we like to sum it up with is, okay, the market sees green ultimately, right? We've seen markets do well with Republican presidents, with Democratic presidents. I think at the end of the day, the market is really looking at, again, the thing that Mark and I keep referencing is, what do companies earn? What are we as investors willing to pay for that that earning stream of that business. So again, we've seen different periods where, again, markets have done well under both, markets have done poorly under both. We don't put a lot of weight on who is in the Oval Office as really being the biggest driver of the market. We really want to look at what are those economic conditions, what's going on with the Fed, what do valuations look like, what do earnings look like they're going to do. We think that is ultimately what drives stock prices in the long run. And again, I think this chart does a pretty good job of showing we've had a pretty good market here for the last 100 years or so years, and we've had a lot of different administrations through that time period. Final two slides. Debt. We know debt is on a lot of people's mind. And yes, the US debt, and we look at it, debt to GDP, that has increased really kind of if we go back to almost those early 80s, right? Where kind of a 40% debt to GDP in those early 80s. And then we've been increasing. And now we're at about 120 times debt to GDP. Okay, we superimpose the S&P 500 on that, right? And what does this tell us? Well, just because debt was increasing over the last 40 years or so, been a pretty good 40 years overall when we look at markets. So we don't want this to be our one determinant on whether we're an investor or not. Yes, it's something we're aware of. I'm not trying to kind of say this is not something we care about. There are times when the market cares a little bit more about the debt and when it cares a little bit less, I would say. And yeah, we know interest rates are going up. So what is that percentage that the government is having to just pay purely on interest? Those are things that we do care about. And we do think, again, something we'll have to see some improvement with kind of where the debt is, what the deficit is. So those are things that we look for as well. But remember, the market is really looking at how our business is able to operate in this environment. And my final slide really shows that interest payments as a percentage of GDP. And you can see on the far right in that red line, yeah, we're seeing that increase, right? Interest rates have gone up. Obviously, that interest expense has gone up to about, 3.5%, a little bit over 3.5%. That's as of September. But I think it's also telling, look at the 80s and 90s. It was actually a higher interest expense, based as a percentage of GDP of what we are dealing with now. So this isn't unprecedented territory. We've actually had periods where that interest expense was actually a little bit more than what it is right now. Fair to say this is the highest level we've seen in 20-something years, right? So again, we're watching this closely, but again, we don't use this as kind of the one factor that's all we're going to look at. We're going to look at this as long as a whole bunch of other factors with the market to determine kind of where we think that big macro picture is. But again, I think puts us into a little bit better perspective when we look at the government debt and kind of where that sits.